Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard.
John, welcome back to the show.
Jim, it's a pleasure to be back on the show and back from a grueling week in Toronto.
Yeah, you just got back from being in Toronto attending the Metals Investor Forum and the PDAC conference. What was the Metals Investor Forum like?
The Metals Investor Forum, which took place on Friday and Sunday, March 3rd and 4th, was the best attended one yet in Toronto, despite the big blizzard that kicked in on Friday and pretty much discouraged a lot of people from making the trip to Toronto. Now, the conference was nowhere near as packed and as enthusiastic as it was in Vancouver at the end of January, but it was still an excellent turnout. When I spoke on Saturday afternoon, I had a three-quarter full audience paying attention to my talk and the five companies in my session. Compare that to last year where I was speaking to maybe a one-third full hall. The snowstorm was something else. It was sort of a wet snow. It's the first time I've ever seen thunder and lightning in a snowstorm. And in the morning, as you're trying to sleep in a little bit, at 6, 7 o'clock, all this snow that had packed onto the side of the building started to fall off, and it was like I was wondering, is there some ice machine outside my door? What is all this clanking of ice cubes into some ice buckets? Who the hell's collecting ice cubes at this time? When it turned out it was all breaking off and smacking against the side of the building, waking up everybody early for the Saturday morning show. Of the companies in my session, the one that was particularly interesting was VR Resources. Most of its presentation was about the Hecla-Kilmer rare earth discovery they have in the James Bay lowland, but they introduced a fairly recent new discovery, the Northway project, which appears to be a kimberlite, a blind kimberlite drilled as a very large mag-low, and it was completely hidden, not available for till sampling, because in this area, everything is covered by a 50 to 100 meter thick layer of limestone that's about 400 million years old. So this, we won't know if it's diamondiferous probably until this time next year, but it was a target that's never been drilled, and it's absolutely huge. It's a 1.2 kilometer wide target. If it ends up being diamondiferous, and there are similar mag-low targets in that area, they've gone and put claims on top of all of them, and they now have kind of a green light to drill, put a hole right into every one of them to see if it's going to be a carbonatite or some other older intrusion that might have critical minerals such as rare earths in it, or if this is part of a new cluster of kimberlites. And of course, the problem with this area, the Kappa's casing structural zone, between 2 and 1 billion years ago, it had a big thermal event. So any diamonds that were created before that would have been turned back to graphite. But in the quiet period since then, this is an area of subduction. They have eclogite in the 40 meters of core that they managed to get before they stopped the hole. The diamonds could have grown back into existence, and the Victor pipe, which De Beers has now mined out, it's about 300 kilometers to the northwest. Its diamonds were only 700 million years old. So this could be a fantastic new discovery. It's a big long shot, but it's kind of like a cherry on top of VR's existing critical minerals portfolio, and it's a gold and copper portfolio in Nevada. So that was sort of an intriguing new development. But the other companies in my session, Brunswick, Harfang, Sirius, they were all part of the Lithium group, focused in particular in the James Bay area, which is shaping up to be a great Canadian area play. And Endurance Gold, which has been under pressure from some seller recently and has turned into a real bargain. It also talked about its Bandito rare earth project in southeast Yukon. None of my peers are yet talking about lithium, which is interesting, but I suspect by this time next year, there'll be a lot more speakers talking about lithium with lithium companies in their session.
What was the Prospectors and Developers Association conference like?
This conference was very well attended. They've reported that there were 23,819 delegates. This is the first full-fledged conference since 2020, after which COVID hit and made the subsequent years not real conferences. June of last year was only a partial several days conference. And when you went down there was a lot of enthusiasm. The aisles were packed. You had to really bob and weave to not smack into people who are busy on their cell phones doing a straight line, not paying attention to anybody in their path. So it was quite an event to just walk around and look at all the booths. Now, 28,000 to 30,000 is what it was in the heyday. That's how many people would show up from all over the world. And we weren't quite there yet. And what seemed to be very much missing was the retail investor. The newsletter presentation runs from early morning Sunday until afternoon. It had about a dozen speakers and panels, and it was absolutely awful attendance. I peeked in around 3 o'clock to see what was going on, and there were a dozen people, and they were all excited to see that somebody else might want to come in and listen, that they all turned around to see who on earth was still going to join this small group listening to these presentations that the speakers had all prepared. And so I checked with some of the other speakers, and they said it was an absolutely dismal turnout. Even Joe Mezendar and Brent Cook, they had a panel discussion situation where people could ask questions. Brent told me there were about 20, 30 people in the audience, and this is a room that can hold several hundred people. And back in the old days, it would be packed with people, especially retail investors, and the blizzard was no longer an excuse for people to not show up at the PDAC. I think the problem is that the PDAC has alienated the retail audience. They insist on charging $25 a head per day to go to the Investors Exchange. One positive development is that they now include the trade show with the day pass. You still can't do the technical session, but I feel sorry for these speakers. They were given the opportunity to buy the all-access pass for 50% off, which meant that they were still going to be paying $300-400 to be able to visit a few technical presentations. And the PDAC seems to have really lost its way. In the old days, you would get this nice brochure that had the location of all the booths, all the technical talks, all the newsletter talks, the time, the location, the titles of them. This time, you had to ask for a brochure of where everything is, and then they would grudgingly cough one up. Everything else was QR code based. So you were supposed to figure out where was what by scanning the QR code and going to the website and poking around and trying to find stuff. This is penny wise, pound foolish. It made it really difficult to figure out where what was. And there's, of course, this big ESG push always at the PDAC. It's like government agencies have taken this over, and everything has to be about how the mining industry doesn't do a good enough job, how Canada has been terrible to Indigenous people, and that all the problems that companies face when trying to get permits in areas that the First Nations claim as their jurisdiction, that's all the company's fault. So there was an awful lot of that. And one thing I found particularly annoying, from the corner there where the Delta Hotel is, there's a winding path to the South Convention entrance. And on Sunday morning, there was still slush on it. The slush had melted and disappeared. But at the end, there was this big pile of snow that the snowplow from the road where the taxis drop off people had been piled up. And I wondered, well, when are they going to move this? Well, this pile of snow, and I heard several people with wheelchairs ended up being obstructed by it, and people just walking along this path had to gingerly step over this. If I was looking for a shovel so that I could there and spend 5 minutes and just shovel it out of the way. How can the PDAC, all these people walking past there, not see this pile of snow that it would take 5 minutes to remove so that it's safe for people and accessible for wheelchairs? This organization that's so full of all this ESG stuff can't notice this mess in front of the main entrance to the conference. It was unfortunate that They seem to have really become myopic. One good thing is if you're 65 and older, an all-access pass costs only $75. So that's an excellent development. It's a better deal than just doing the day pass. But it was fantastic, though, to be there again, to be able to walk the floor, visit the government entities, some of the equipment and service companies, and find out what the latest innovations were. And then, of course, there were 400 plus companies exhibiting, including large major companies with the core shack. So it was wonderful to see it all in action again. But it would be nice if they did something to accommodate the retail investors, maybe even just make access on Sunday when retail investors are free and don't have to work, make it free for them to come there. Otherwise, just forget about the newsletter presentation or any pretense that this is anything but an industry show.
What was the buzz at PDAC?
I would go around and ask, people at the various booths, what are the delegates here asking about? And I would hear this, lithium, lithium, lithium. It seems lithium was the big theme. The energy transition was a major topic. So copper was also very much on people's minds because as the International Energy Agency has projected that for the 2030 electric vehicle deployment goals to be met, there needs to be a 50% increase in copper supply by 2030. And when you think that it's already a nearly $200 billion a year market and adding another $100 billion worth of copper over the next 8 years, that's a really big deal. So there was a lot of investor interest in the in companies with copper exploration or even feasibility demonstration plays. But lithium was the big word on everybody's lips. And I heard in Indaba at the beginning of February, this is the big African conference held in South Africa's Cape Town. It was the same thing: lithium, lithium, lithium. And what was interesting was the Albemarle, the big producer that's based in the United States, it had a booth present for the first time, and it was an exploration booth. So the signal was clear. They have primarily been a brine producer with the Silver Peaks project in Nevada, but they also now have joint venture stakes in pegmatite operations in Australia. They're looking at the hard rock pegmatites as a way to expand their future revenue growth. This, of course, was a bad week for lithium carbonate. It continued to drop. It looks like it's falling off a cliff from a high of $35 a pound last year. It spent most of last year between $30 and $35 a pound. It's now almost $21 a pound, down 40% from the peak. And that has helped launch a big bear attack against the producers and the more advanced companies as the battery makers are trying to get the price down to a lower level. And I've argued all along that $10 to $15 per pound is what you really should be focused on as a long-term price. You go lower than $10 a pound, and these pegmatite projects start looking marginal. You need $10 a pound, and even at $10 a pound, we're talking about a 1% grade lithium oxide grade deposit. That's equivalent to a third of an ounce, and you double the grade to 2%. So that's 2/3 an ounce. So we're still talking sort of $600 to $1,200 rock value. And these things are going to be largely open pittable, or if they are going to be underground mineable, there'll be very wide zones that will be mined underground. So there is still huge value available in that $10 to $15 range. So as far as I'm concerned, let it continue to drop and then stabilize in the $10 to $15 per pound range. Now, SQM had a booth also, and my understanding too is that SQM wants to go beyond producing brines from the salars and the lithium triangle. And I had a chart at my presentation showing the comparative supply growth between Australia, Chile, and China. And Australia, of course, ramps way up starting about 2017-18. That was Australia responding to the predictions of very large lithium demand growth and mobilizing pegmatite supply. But I was shocked at the relatively muted growth of Chilean lithium carbonate equivalent output. Obviously, it's not so easy to mobilize a lot of new supply from the salar brines, and the key is direct lithium extraction. This is just putting the brine out in the open and waiting a year or two for it to dry out, and perhaps losing the water, and not having it hit the range and precipitate and fall back into the salars and allow for the brines to be recharged with lithium. Direct lithium extraction is what needs to really work to ramp up brine supply. And I'd, of course, not quite understood all this back in 2015-18 when I assumed that the lithium brines on the lithium triangle would take care of all the new demand required. And the new demand now, the IEA says, it's got to be the supply's got to be 600% more than it is now. And even if you take $10 a pound as the future price, that means by 2030, lithium supply will be $100 billion a year market. So when groups like SQM are there looking at the hard rock, this is very good for what I call lithium mania 2.0. And of course, the companies, they are all scrambling to acquire lithium projects. Even that last week, over the past week, there were many announcements of companies either realizing that they have lithium potential on existing gold or base metal plays, or staking claims that they researched in the archives, or even optioned from somebody else who did the research and staked the claims. And in addition to industry groups walking around looking at asking about lithium supply potential from these pegmatite juniors, there was also the sort of American institutions, fund managers, bigger money that's interested in investment. They were there prowling also. Conspicuous by their absence was the retail investor. The Canadian retail investor still does not understand the lithium game, how big this market will become, and these pegmatites that they discover, how incredibly high rock value they are. I mean, who can imagine finding a half-ounce gold deposit, 10 million tons of half-ounce gold, sitting on surface as a nice long zone that can be open pit mined? That isn't possible anywhere in the world. But with lithium, this is what the game is. So the buzz was lithium, and copper, but not that much interest in gold. Gold seems to have been, sidelined in this critical minerals rush that's now underway.
Resource juniors started dropping while PDAC was still underway. Do you still think the PDAC curse will be violated this year? Well,
just for those who don't know what the PDAC curse is, just a reminder, it's when the New Year effect kicks in January after the juniors get cremated in December by tax loss selling. This usually climaxes at the PDAC. And yes, the spirits, everybody was in good spirits. Everybody was happy. The buzz was positive. But what usually happens is shortly after the resource junior traded value, it goes down. The price goes down. And that's because people know that you're supposed to sell in May and go away. So everybody does that right after PDAC so they don't get hurt by all the later selling by those who don't know that you're supposed to sell in May, but actually do it before that. But in the years where it gets violated, there is still usually a lag of a couple weeks, several weeks after the PDAC has completed. I mean, people are exhausted. Everybody was tuned into this conference. They're now at home figuring out what it is that they learned, what they need to follow up on. But there's usually some big picture development that kicks off the violation where everything starts going up in April and then continues right through the summer, hardly dented by the summer doldrums. Now, this week, the damper that was put on stock prices was Jerome Powell's comments that the inflation continues to be persistent. We're going to have to increase rates higher to subdue inflation. And a lot of people like myself think you're going to have to live with higher inflation because we're dealing with a huge deglobalization process, reshoring manufacturing from places like China, and also rethinking where your raw material supply is coming from as the geopolitical conflict between great powers continues to escalate, the United States versus China. And this was not a particularly good week for this relationship to calm down. It has, in fact, gotten worse. And then today we get the news that a Californian bank, the Silicon Valley Bank, has failed and has been taken over by the government. So everybody's thinking, here we go again. 2008, and the Federal Reserve is determined to crank up interest rates even higher. When you look at it, the interest rates really are still less than a third of what Paul Volcker did between 1980 and 82, when he jammed them up to 21% or so in his fight to subdue inflation. And if the Federal Reserve starts doing something like that, we're going to definitely have a recession. The yield curve is inverted once again. People are expecting the short-term rates are going to be high, much higher than long-term rates, and eventually they'll have to lower it. And normally you would say this is going to be bad for resource juniors. So we've seen, especially today, we saw stocks being sold off, though the better ones did bounce back after the drubbing in the morning. But one has to consider that even if we have this recession coming from high interest rates, the problem that the market is looking at, at least the democracies of the world are looking at, is the raw material supply problem. It's not going away. You have the energy transition asking for 600% more lithium, 50% more copper, 100% more nickel, 100% more rare earths than we're producing now to meet the net zero emission goals for 2030. Plus you have geopolitical supply disruption potentially coming, where what used to come from China and Russia and countries that are sort of under their control, that may no longer be coming. So there's going to be a boom in resource juniors. The wake-up hasn't quite happened, but there were signs that some government agencies, such as Ontario, was less focused on ESG stuff, but we're actually thinking, okay, how can we shorten the permitting timeline? How can we make it quicker so that the juniors can, generate their targets and drill them? And once they've delineated a deposit, can we make the whole sort of make sure it's developed in a sustainable, environmentally friendly manner? How can we make this happen quicker? So this is starting to happen, and I think we're going to hear more about that. But in terms of the trigger that causes the violation of the PDAC curse, even though we see the lithium price falling now, that doesn't matter. Everybody's thinking long-term prices $10 to $15 per pound. Anyways, I think we're going to see a major development sometime in the next quarter. Patriot Battery Metals has 5 rigs going on the CV5 drilling between the first 2 kilometers, now extending it another 2 kilometers towards the CV4 showing. They want to get this done as soon as possible and have a resource estimate out sometime in June. But everybody who has a leapfrog is already pouring the numbers in. So the big potential event is that one of these big companies makes a move in order to lock up that 55-kilometer trend in which there could be multiple CV5 type deposits, which right now I can see 50 million tons. And if they do double the strike of this with similar grades and widths, we have a potential 50 to 100 million ton resource that's going to show up, and somebody is going to make a move because the big mining companies cannot afford to ignore a metal that was worth $200 million in 2005, but by 2030 will be $100 to $200 billion a year market. They cannot afford to leave that to new juniors like Pilbara and Mineral Resources, companies that have now 12 to $16 billion market caps, who have the muscle to acquire these projects and expand their existing operations. So the James Bay Great Canadian Area Play, I think, is poised for liftoff probably triggered by some event involving Patriot Battery Metals and its Corvette project in the James Bay region.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser. I'm Jim Goddard.
Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.